AI stocks have been under pressure, and many investors are wondering what's really behind the latest sell-off. In a recent CNBC interview, 𝗗𝗟𝗏, Fundstrat's head of research and chief investment officer, shared his thoughts on what's dragging the market lower, why investors are finally sobering up after a massive rally, and whether this pullback is something investors should actually be worried about. First, I'll show you the clip of 𝗗𝗟𝗏 explaining what's really behind the AI stock sell-off. Then I'll break down exactly what he said and give you my own reaction and analysis. After that, we'll take a deep dive into 3 insanely cheap stocks that could be worth buying during this market sell-off. Let's hear what 𝗗𝗟𝗏 has to say.
Hey, Tom, what do you think of this news? Certainly in light of the Alphabet news earlier this week, is this a good sign or a worrisome one?
Scott, I think Meta's move isn't surprising because Google had a lot of success raising $45 billion in a very short underwriting period. And I think it's a reminder that these AI companies are building basically, huge real estate infrastructures that aren't fully funded today. And that's why not only will SpaceX need to raise more money beyond its IPO, and OpenAI and Anthropic, and of course Meta and Google, but I do think they're showing a lot of promise in their investment today because there's been significant breakthroughs. So I think investors are going to give them grace, but you're right. I think Stephanie's right. This is not Meta's sort of financial profile is changing. It's changing from a free cash harvesting from their prior businesses to one where they're building land that could end up being beachfront property.
What's this sell-off about today, Tom? Did Broadcom spook the market? Did they start this? Is it positioning ahead of SpaceX and the biggest IPO we've ever seen? Is it something else? What do you think?
Scott, I think a lot of this, for instance, memory stocks are down, but they're back to where they were 8 days ago. I think the market did have a parabolic lift in the last month. And now I think there's some sobering taking place because expectations are higher. But I also think that SpaceX, $75 billion is a lot to ask the public to fund. So I think it is a big lift in terms of how you're going to fund that purchase. And so I think now when the stocks wobbled a little bit, I think people are raising cash. I don't think that this is the start of a broader correction yet, but as you know, we do think that later this year there's going to be something that feels like a bear market. Today's not fun, though.
The conversation starts with concerns about profitability and operating margins. Investors have traditionally rewarded companies that consistently grow earnings, expand margins, and generate strong free cash flow. But the AI era is changing that formula. Companies that were once cash-generating machines are now pouring enormous amounts of money into infrastructure, data centers, chips, networking equipment, and AI development. 𝗗𝗟𝗏's response suggests that investors are becoming more willing to tolerate this shift because they believe the opportunity is so large. In his view, the market is not surprised by Meta's latest spending plans because Alphabet has already demonstrated that investors are willing to support massive capital raises when the purpose is to build AI infrastructure. What I find interesting here is that we are witnessing a complete reversal of how Wall Street used to think. Just a few years ago, investors would punish companies for dramatically increasing spending if it hurt profitability. Today, many of the largest technology companies are essentially being rewarded for spending more, as long as investors believe that spending is tied to artificial intelligence. That creates a fascinating dynamic. Investors are no longer just evaluating current earnings. They're trying to estimate who will own the most valuable AI infrastructure 10 years from now. 𝗗𝗟𝗏 makes a comparison that I think is particularly important when he describes these AI investments as building real estate that isn't fully funded yet. What he is really saying is that these companies are constructing the foundational infrastructure of the next technological era. Think about it this way. During previous economic booms, companies invested heavily in railroads, telecommunications networks, oil infrastructure, and internet connectivity. The winners were often the companies that built the roads everyone else had to use. In today's environment, AI data centers may become the equivalent of those digital highways. Tom Lee argues that Meta, Google, OpenAI, Anthropic, and even SpaceX are all pursuing projects that require enormous amounts of capital because the scale of the opportunity is enormous. These companies are spending money at levels that would have seemed unimaginable a decade ago. What's particularly noteworthy is his belief that investors are willing to give these companies grace because of the breakthroughs that have already occurred. That is a critical point. The market is no longer treating AI as a speculative concept. Investors have already seen enough evidence to believe that artificial intelligence can transform productivity, software, search, content creation, and even entire industries. Because of that, shareholders are more willing to accept near-term financial pain in exchange for potential long-term rewards. Personally, I think Tom Lee is correct on this point. The AI revolution has already moved beyond the theoretical stage. We are seeing real products, real adoption, and real business applications. The debate now isn't whether AI matters. The debate is which companies will capture the most value from it. Another part of the interview that stood out to me was when Tom discussed Meta's changing financial profile. For years, Meta was viewed as one of the greatest cash-generating businesses in the world. Its social media platforms produced enormous amounts of profit and free cash flow. Investors could count on strong margins and highly predictable earnings. Tom argues that Meta is no longer simply harvesting cash from existing businesses. Instead, it is transitioning into a company that is actively investing in future opportunities. His analogy about building land that could become beachfront property is incredibly powerful. When someone buys undeveloped land, there is uncertainty. The land might become extremely valuable in the future, or it might not. But if you believe a major city is going to grow around that land, then the investment can generate extraordinary returns. That is essentially how Tom Lee views AI infrastructure spending. Companies are acquiring strategic positions today that could become extraordinarily valuable tomorrow. Of course, this transition comes with risk. Higher spending means lower margins. Lower margins can create earnings pressure, and earnings pressure often leads to stock volatility. That brings us to the next major topic in the interview, which is the market sell-off. The hosts asked Tom whether Broadcom triggered the weakness, whether investors are repositioning ahead of SpaceX's anticipated IPO, or whether something else is driving the decline. Tom's answer is surprisingly calm. Instead of focusing on a specific catalyst, he points out that many stocks have simply retraced to levels they were trading at just days earlier. In other words, the sell-off may look dramatic on the surface, but in many cases it is simply a pullback after a very powerful rally. This is an important reminder because investors often become emotional during market declines. When stocks are moving lower, headlines tend to exaggerate the significance of every red day. But Tom is essentially saying that context matters. If a stock rises rapidly over several weeks and then gives back a portion of those gains, that doesn't necessarily signal a major change in the underlying story. According to Tom, one reason for the weakness is that expectations became elevated after a powerful run higher. This is something I talk about frequently because expectations drive markets just as much as fundamentals. A company can report excellent results and still see its stock decline if investors were expecting something even better. Likewise, a stock can rise after mediocre results if expectations were extremely low. The challenge facing many AI-related stocks today is that expectations have become incredibly ambitious. Investors are projecting massive revenue growth, extraordinary profit opportunities, and transformational business models. When expectations reach those levels, even small disappointments can create volatility. Another fascinating point Tom raises involves SpaceX and its enormous capital requirements. He notes that asking public investors to fund a $75 billion offering is a massive undertaking. Think about the scale of that number. Even in today's market, $75 billion represents a tremendous amount of capital. For investors to absorb an offering of that size, money has to come from somewhere. This creates what many market participants refer to as liquidity effects. If investors want exposure to a highly anticipated new opportunity, they may sell existing positions to free up cash. That can create temporary pressure across other areas of the market. Tom appears to believe that at least part of the recent volatility could be related to investors preparing for that possibility. I think that's a reasonable argument. Whenever a major investment opportunity emerges, capital tends to rotate. Investors constantly reassess where they believe future returns will be highest. If SpaceX ultimately becomes available to public investors, it would likely attract enormous interest because of its leadership position in commercial space, satellite communications, launch services, and potentially other future businesses. What makes Tom Lee's overall message so interesting is that despite discussing margin pressure, elevated expectations, increased spending, and market volatility, he doesn't sound bearish. Instead, his comments suggest that he views these developments as natural growing pains associated with a technological revolution. The underlying theme running through this entire interview is that artificial intelligence is forcing investors to rethink traditional valuation frameworks. Companies that once prioritized maximizing margins are now prioritizing maximizing opportunity. Investors who once demanded immediate profitability are now focusing on long-term strategic positioning. Markets that once rewarded efficiency above all else are now rewarding companies willing to build the infrastructure of the future. Whether that ultimately proves correct remains to be seen, but Tom Lee clearly believes that many of these investments could create enormous value over the coming decade. And from my perspective, that is really the key takeaway from this discussion. The market is no longer debating whether AI will reshape the economy. The market is debating who will emerge as the dominant winners and how much investors should be willing to pay today for that future potential. Now let's dive in and talk about 3 insanely cheap stocks you can buy now during this recent market sell-off. These are businesses that dominate their niches, generate real cash flow, and have long-term staying power that most investors completely overlook until the market wakes up again. The first company sets the tone perfectly for that idea. Chewy, ticker symbol CHWY, is one of those stocks that tells you everything you need to know about how investor sentiment can completely disconnect from business reality. To understand Chewy, you have to go back to the pandemic era. At that time, Chewy was one of the standout e-commerce winners. Pet ownership surged, online ordering exploded, and Chewy became the go-to destination for pet food and pet supplies. It had strong customer service, aggressive pricing, and a business model that looked like it could challenge even the biggest names in retail. For a while, investors treated it like a long-term growth engine. Then the world normalized. People started leaving their homes again, returning to physical stores, and shifting spending patterns back into traditional retail channels. And almost instantly, the market narrative around Chewy changed. What was once a high-growth favorite became a forgotten stock. But here is where things get interesting, because while the story changed, the actual business did not collapse. In fact, the numbers tell a very different story. Even after the post-pandemic reset, Chewy continued growing sales. In fiscal 2025, which ended on February 1st, net sales increased by 6%. That is not explosive growth, but it is steady expansion in a mature environment where many investors expected stagnation. And that is only part of the picture. Net income jumped 21% during the same period. Free cash flow rose 24% to $562 million. So while sentiment shifted lower, profitability and cash generation actually improved. This is one of the most important disconnects in investing. When a stock is falling for a long time, people assume the business must be weakening. But in Chewy's case, the business is quietly becoming more efficient, more profitable, and more cash generative, while the stock moves in the opposite direction. That kind of divergence is exactly where long-term opportunities tend to form. Now the real question is why Chewy still matters in a post-pandemic world. The answer is simple but powerful. Pets are not a trend. They are a permanent part of household spending. Unlike discretionary consumer products, pet care sits in a category that behaves almost like a necessity for millions of households. Food, medication, and basic care do not disappear when the economy slows down. This creates a stable demand base that many e-commerce companies would envy. But Chewy is not just selling pet food anymore. The company has been steadily building a broader pet care ecosystem that goes far beyond traditional retail. It now offers pet pharmaceuticals, digital veterinary services, and in some cases, even in-person veterinary care. That shift is extremely important, because it changes Chewy from a simple online retailer into a recurring revenue platform for pet health and wellness. Think about what that means at scale. A customer who initially buys pet food can now stay inside the Chewy ecosystem for prescriptions, vet consultations, preventative care, and ongoing health needs. Each added service increases customer stickiness, and once customers integrate a platform into their routine, churn tends to drop significantly. That is how durable businesses are built. Now here is where valuation becomes interesting. On the surface, Chewy does not look cheap if you only look backward. It trades at a trailing price-to-earnings ratio of around 39. But markets do not price stocks on the past, they price them on expectations. And forward expectations tell a very different story. Chewy's forward earnings multiple has dropped to roughly 13. That is a dramatic shift in valuation perception. A forward PE of 13 puts Chewy in a category where investors are no longer pricing in high-growth optimism. Instead, they are pricing in moderation and uncertainty. The opportunity comes from what happens if those expectations are wrong. If Chewy continues growing even at a moderate pace and continues expanding its higher margin services like pet healthcare, then earnings could compound faster than the market currently anticipates. And when earnings surprise to the upside while valuation is compressed, that is when long-term re-rating potential begins. This is why some analysts believe Chewy could be one of the most overlooked turnaround stories in consumer e-commerce today, not because it is reinventing itself as a hype-driven growth company, but because it is quietly evolving into a more complete pet care ecosystem while the market is still pricing it like a fading pandemic beneficiary. Even more compelling is how far the stock has fallen relative to fundamentals. Despite improving profitability, stronger cash flow, and continued revenue growth, Chewy's stock is down more than 50% over the past year. That kind of price action creates a psychological disconnect. Investors begin to assume something must be broken. But in Chewy's case, what is actually happening is simpler. The narrative collapsed faster than the business did, and when that happens, valuations can become disconnected from reality long enough to create opportunity for patient investors. This is why Chewy stands out as the first stock on this list. It is not about explosive growth. It is about steady compounding, improving margins, expanding services, and a market that may have overshot on the downside. Now, of course, no investment is risk-free. Competition in e-commerce is still intense, and execution in new service areas like veterinary care will matter a lot over the next few years. But when you step back and look at the combination of cash flow growth, expanding ecosystem strategy, and compressed forward valuation, Chewy starts to look less like a fading pandemic story and more like an underappreciated platform quietly building long-term value. And that is exactly why it deserves attention right now. If this resonates with you, you're exactly who this channel is for. Please hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. Now we move into a stock that perfectly captures what happens when a well-known brand loses investor confidence and then slowly begins trying to rebuild it from the inside out. Target, ticker symbol TGT, is one of the most recognizable retail brands in America. For decades, it was seen as the sweet spot between discount shopping and premium experience. Clean stores, strong merchandising, and a loyal customer base made it one of the most reliable performers in the retail space. But over the last few years, that reputation started to break down. Inventory problems piled up, product selection became inconsistent, store conditions deteriorated in some locations, and management decisions, both operational and strategic, left many investors questioning whether Target had lost its edge. The result was a sustained period of weak performance that pushed the stock firmly out of favor. And when a stock becomes unloved for long enough, the narrative starts to harden into a belief that recovery is unlikely. That is usually where the most interesting turnaround stories begin. Because while sentiment was deteriorating, something important was happening behind the scenes. Leadership changed. In February, former Chief Operating Officer 𝗗𝗚𝗏 stepped into the CEO role. Leadership transitions like this matter far more than most investors realize, because they often signal a shift in priorities, urgency, and execution strategy. And in Target's case, that shift has been aggressive. Management committed to investing approximately $5 billion into revamping the business. That level of investment is not a cosmetic adjustment. It is a structural attempt to rebuild operational strength. The plan includes upgrading store layouts, improving supply chain efficiency, expanding staffing, and investing heavily in technology. Each of these areas directly addresses the problems that have weighed on the company. Better stores improve customer experience. A more efficient supply chain reduces inventory mistakes. More staff improves service quality. And technology upgrades improve long-term operational execution. When you combine these initiatives, what you are really seeing is a full-scale attempt to reset the business model from the inside. Now here is where things start to get interesting from an investor perspective. Turnarounds rarely show up all at once. They usually begin with small signs of stabilization before becoming visible in the headline numbers. And Target is starting to show those early signs. After years of weakness, the company reported a 7% increase in net sales in the first quarter of fiscal 2026, which ended on May 2nd. That might not sound dramatic on its own, but context is everything. In fiscal 2025, Target saw a 2% decline in net sales, so the shift from decline to growth represents a meaningful inflection point. This is the kind of early signal investors look for when trying to identify whether a turnaround is taking hold. It does not guarantee success, but it suggests momentum may be changing direction. And momentum matters in retail more than almost any other sector, because retail is ultimately driven by consumer perception. When shoppers feel better about a brand, traffic increases. When traffic increases, inventory moves faster. And when inventory moves faster, profitability tends to stabilize. However, the story is not all positive yet. As Target began investing heavily into improving operations, costs increased significantly. Selling, general, and administrative expenses rose as the company hired more staff and invested in systems upgrades. As a result, net earnings fell by 25% over the same period. At first glance, that looks like a deterioration, but it is important to separate structural weakness from intentional investment. There is a big difference between a company losing earnings because demand is collapsing and a company losing earnings because it is spending aggressively to fix long-term problems. Target appears to be in the second category. It is choosing to sacrifice short-term profitability in exchange for rebuilding long-term competitiveness. That is never comfortable for shareholders in the short run, but it is often necessary for long-term survival in highly competitive industries, and investors seem to be starting to recognize that shift. Management recently raised its fiscal 2026 sales growth forecast to 4%, up from 2% previously. Forecast upgrades are important because they signal confidence from leadership. Executives typically have better visibility into supply chain data, customer behavior, and internal performance trends than outside analysts, so when guidance improves, it often reflects real underlying changes in business momentum. If Target can sustain even mid-single-digit growth while improving operational efficiency, the financial profile of the company could begin to shift meaningfully over time. Higher sales combined with better cost control would eventually lead to operating leverage. And operating leverage is what drives margin expansion in mature retail businesses. Another key part of the Target story is its dividend. Unlike many companies that cut or suspend dividends during difficult periods, Target has maintained a remarkable track record of consistency. The company has increased its dividend for 54 consecutive years. That places it in a very rare category of long-term dividend reliability. It means Target has survived multiple recessions, inflation cycles, shifts in consumer behavior, and competitive pressure, while continuing to reward shareholders. Today, the stock offers a dividend yield of approximately 3.7%. For many investors, that creates a second layer of return on top of any potential price recovery. You are not just betting on a turnaround, you are also getting paid while you wait. That combination often attracts income-focused investors who prefer stability with upside potential rather than high-volatility growth plays. From a valuation perspective, Target trades at around 16 times earnings. That multiple reflects skepticism but not despair. The market is not pricing Target as a broken company. It is pricing it as a company still proving whether its turnaround will succeed. And that distinction matters. Because when expectations are low but not catastrophic, even moderate improvements can lead to meaningful revaluation. If sales stabilize, margins recover, and consumer confidence returns, the stock does not need perfection to perform well. It simply needs progress. That is the core of the Target investment case. A well-known brand that lost its way is now investing heavily to fix its weaknesses and is beginning to show early signs that those efforts may be working. Whether that translates into a sustained recovery remains to be seen, but the foundation for a turnaround is clearly being built. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now we arrive at the final stock, and in many ways, this is the one most investors overlook completely. Campbell's, ticker symbol CPB, is not the kind of company that typically dominates financial headlines. It is not exciting, it is not disruptive, and it is not associated with high-growth narratives or cutting-edge technology. But what it does have is something far more important in certain market environments: stability. Campbell's is one of the most established packaged food companies in the United States. Its product lineup includes Campbell's Soup, Prego Pasta Sauce, V8 Beverages, and Pepperidge Farm Baked Goods. These are not niche products. These are household staples that have been part of consumer shopping carts for decades. And that longevity is the key to understanding the business. Because while investor attention shifts from one trend to another, people continue buying food. They continue buying packaged goods, and they continue relying on brands they recognize and trust. However, despite this stability, Campbell's has been under pressure. Over the past several years, investor sentiment toward packaged food companies has weakened significantly. Consumers have increasingly shifted toward natural, organic, and fresh alternatives. At the same time, rising input costs have squeezed margins across the entire sector. Campbell's has not been immune to these trends. In the second quarter of fiscal 2026, which ended on February 1st, the company reported a 5% year-over-year decline in sales. That followed a 3% decline in the prior quarter. Net earnings also dropped by 16% during the same period. On the surface, those numbers paint a picture of a company under pressure on multiple fronts. Slower sales, rising costs, declining profitability, and it is exactly this kind of data that has driven investor pessimism over the stock. But markets do not only respond to current performance, they respond to expectations about the future. And in Campbell's case, expectations appear to have fallen to extremely low levels. The stock now trades at roughly 11 times earnings, which places it at one of the lowest valuation levels in the consumer staples sector. To understand how unusual that is, you have to consider the nature of the business. Campbell's is not a speculative company. It is not an early-stage startup. It is a mature, globally recognized brand with decades of operating history and deeply embedded distribution channels. Yet the market is pricing it as if its long-term growth prospects are permanently impaired. That creates an interesting question for investors. Is this a company in structural decline, or is this a mature business going through a difficult cycle that has already been fully priced into the stock? One of the most important things to recognize is that Campbell's is not standing still. Like many packaged food companies, it has been adjusting its portfolio to better align with evolving consumer preferences. Management has been increasing focus on healthier product offerings while continuing to defend its core categories, where it still holds strong market share, particularly in soup. This is important because it shows the company is not ignoring industry trends, it is adapting to them, and adaptation is often the difference between long-term relevance and gradual decline. Still, even with these efforts, financial performance remains under pressure. But here is where valuation begins to matter. At 11 times earnings, Campbell's is priced as if little to no growth is expected going forward. That level of pessimism can create opportunity if the underlying business stabilizes even modestly, because in markets, expectations matter just as much as results. If a company is expected to decline and instead it merely stabilizes, that can be enough to drive a re-rating in the stock. Now add income into the equation. Campbell's offers an annual dividend of $1.56 per share, which translates to a yield of approximately 7.4% at current prices. That is a significant payout for a consumer staples company. It means investors are being compensated while they wait for the business to stabilize. This changes the risk profile in a meaningful way. Even if the stock does not appreciate quickly, the dividend provides ongoing return. And in some cases, that income stream becomes a key part of total long-term performance. Unlike Target, Campbell's does not have a long streak of annual dividend increases. However, the company has maintained and gradually grown its payout over time, reflecting a consistent commitment to returning capital to shareholders. From a broader perspective, Campbell's represents a very different type of investment compared to the other two stocks discussed in this video. Chewy is a growth and ecosystem expansion story. Target is a turnaround and operational recovery story. Campbell's is a value and income story. Each one is responding to different market pressures, and each one appeals to a different type of investor psychology. Campbell's in particular appeals to investors who are willing to look beyond short-term growth rates and focus on cash flow, brand strength, and valuation discipline. The stock trades near its lowest levels since the mid-1990s, which highlights just how far sentiment has shifted over time. But long-term investors know that extreme pessimism does not always last forever. Sometimes it simply reflects a business going through a difficult cycle rather than a permanent decline. And if Campbell's can stabilize sales while maintaining its brand strength and cost discipline, the current valuation could eventually look disconnected from reality. When you step back and look at all three companies in this video, a common pattern emerges. Each one is currently out of favor, each one has experienced a period of negative sentiment, and each one is trading at valuations that reflect skepticism about the future. But underneath that skepticism, all three businesses continue to operate with strong underlying assets. Chewy is building a pet care ecosystem with recurring revenue potential. Target is investing heavily in a full operational turnaround backed by a strong brand and decades of retail experience. Campbell's continues to generate stable cash flow from some of the most recognizable food brands in the country while offering an unusually high dividend yield. This is where investing becomes less about chasing momentum and more about evaluating long-term probability. The question is not whether these companies are perfect today. The question is whether the market has become overly pessimistic about their future. If even one of these businesses performs better than expectations over the next several years, the current valuations could look extremely attractive in hindsight. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the StocksGalore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/StocksGalore and become part of our growing community of smart investors. Link is in the description. Now I want to hear from you. Which of these 3 stocks do you think has the strongest long-term advantage? Chewy with its expanding pet care ecosystem, Target with its retail turnaround strategy, or Campbell's with its defensive consumer staples positioning and high dividend yield? Share your thoughts in the comments. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.